Okay, well, good morning or good afternoon, everybody. My name is Cindy Troston, and I've been doing this seminar now for a few years, and I'm always glad to be here. It's always a fun group because there are always a lot of questions. During the time of the presentation, if you have questions, please enter them into the chat box. And my associate who's sitting next to me here, Drew Mays, is going to be monitoring the chat box. Some of the questions we may use during the presentation, and others of them we may wait till the end. So we are allowing some time at the end of the presentation for questions that pop up then or now. So enjoy the presentation, and please don't be afraid to ask questions, because if you have a question on your mind, it's probably another 10 people have the same question on their minds. So I always love to have questions as I go. It makes it a little bit more interesting. We do have a lot of information to present, and hopefully it will be enjoyable as well as informative. So first, let me tell you a little bit about myself. I am a JD LLM in taxation, taught for many years at University of Illinois, which was previously John Marshall Law School in tax accounting. We have a practice here in Northbrook, where we practice in tax, estate planning, and business transactional law. We're licensed in Illinois, Kentucky, and Wisconsin. So the agenda for today is I'm going to go over a little bit of what's new in 2025, the general personal income tax updates that we can expect, talking about 2024 and 2025, because you're going to be concerned about getting your 2024 taxes filed pretty soon. I'm going to go over the business deductions for both years, retirement plans, talk a little bit about gift and estate tax and where that's going, Illinois specific tax updates, and what's not on the agenda, but if we have time, I'd like to talk a little bit about the FBAR, which some of you have heard about, or many of you have heard about, but may not know a lot about, toward the end of the discussion. So what's new in 2025? Well, first of all, filing deadlines for 2024 taxes are going to be on April 15th this year. Sometimes they're on the 16th or 17th, but I believe today, this year, they're going to be on the 15th. If you file a timely extension, you can have up to October 15th to file your taxes. What I want to caution you for, though, is if you file your tax, if you don't file your taxes by April 15th, but you file a timely extension, you still have to make sure that you file and you make, that you make your payment by April 15th, because your payment will be late if you file your tax return later in the year, on or before October 15th, timely filing, but late payment of tax if you do owe a tax. So try to figure out what you might be owing and pay that by April 15th so you're not penalized for an underpayment. The recent tax acts, we're going to talk a little bit about the Secure Act, retirement changes, and the Tax Cuts and Jobs Act sunset planning, which is coming up at the end of this year. The Secure Act is going to be affecting a lot of retirement savings rules for employers and employees. And we're going to talk a little bit about that when we get into the retirement portion of the presentation. But the Tax Cuts and Jobs Act, that's the plan that was enacted in 2017. That is what we're currently paying and filing taxes under right now. That does end at the end of this year, unless it's extended by Congress during this year, before the end of the year. And so there are a lot of items on the tax forms that you're used to filing, such as the standard deductions and the SALT tax, et cetera, that are currently in place, miscellaneous deductions. It also affects gift tax and estate tax. And so all of those things are going to revert back to pre-17 inflation adjusted amounts, unless Congress takes action to extend them. Working with the IRS. This is something that in my practice, I always have on my agenda, working with the IRS and how long it actually takes to get things done. E-file returns are the way to go. if you have the ability to e-file your return for yourself or your clients, certainly that's the way you want to file. IRS says that it takes about 21 days to process a typical e-filed return. And I actually find that that's a conservative number. It's usually less than that, usually around 14 days, that tax return will be processed and you'll be expecting to get a refund if you're going to be receiving a refund. Amended returns, on the other hand, they can also be e-filed, but a lot of times amended returns have to be filed on paper. And those returns right now are in the queue at the IRS being processed for those that were filed last July. So it does take a lot of time for the IRS to file and process a paper return. So you have to be patient if you're going to be filing any kind of return on paper with the IRS. And I always want to say, be patient with your tax preparer, whether it's a preparer, an accountant, a CPA, an enrolled agent, or an attorney. There's only so much we can do as far as getting information from the IRS. So unless we get that information and have access to it, we can't help move your tax matter along. One of the things is when you're working with a tax attorney or an accountant on a past due tax or a tax issue or a tax problem or a tax audit, oftentimes the tax preparer will ask you to file a power of attorney with the IRS. It's called Form 2848. And that document either gets faxed to the IRS, so we still actively use a fax machine around this office, or it can be uploaded to the IRS's website, but it takes several weeks for the IRS to process that return, no matter how they receive it. So again, patience is the key. When you're working with a tax practitioner, it takes a while for us to be able to even get access to your tax information online. New in 25, the mileage rate. It jumps from 67 cents a mile in 2024 to 70 cents a mile in 2025. And that's an amazing amount. We're going to talk a little bit more about that in detail in a few minutes. But this is the same whether you have a gas or an electric vehicle. Upcoming reporting requirements on K1s. I'm sorry, 1099Ks, excuse me. This is something that's been in the works for years, but is just starting to become an issue. In 2024, third-party settlement organizations such as an eBay, a StubHub, Etsy, processing your sale of items online will send a 1099K to you if you have in excess of $5,000 for one of those sales. In 2025, that limit is going to drop down to $2,500. So if you're selling something online, you're going to get a 1099K at the end of the year saying that you sold something for $2,500 or more, and you need to report that somehow on your income tax return. In 2026, it's going to drop down even further to $600. So be cautious if you're selling something online, you're going to have to report those items for income tax return purposes now. Tax proposals being considered. Let me see. On the table right now is the corporate tax rate. These are things that are being discussed by Congress. There's nothing that's concrete yet, but they're on the table, and some of these things that were thrown out there during the campaign may stick, some may not, but there's going to have to be balance on allowing one thing on the income side, taking another thing on the deduction side. So corporate tax rates right now are currently at around 24% for the top rate. They're currently being considered to be lowered to a 15 to 20% rate. And people often wonder, why do we do that? Why should we do that? And there's a lot of balance that goes into that, with US corporations being able to be taxed in this country at a lower tax rate versus going overseas to another country to be taxed at a lower rate than we're charging them in the US. So it's again a a balance of where the employees of those corporations are going to be, where the tax revenue is going to be flowing, and where the jobs are going to be. So those are all issues on the table. The SALT tax, which a lot of us have heard about, that's the state and local tax that we take on our itemized deductions. It's currently capped at $10,000 for income tax, property tax, personal tax, intangible tax. They're talking about making that permanent, but might increase it to $15,000 per person and $30,000 for a joint return. So they're talking about all different kinds of options that they might have, but pretty much it's going to be staying around in some form. No taxes on tips or overtime work. There's a lot of that being bantered around. It's not permanent yet. It's just being talked about. No taxes on Social Security payments. That helps people who are in lower income categories, but in higher income earners, they're getting a free ride on not having tax on any of their Social Security payments. And then they're always talking about ending carried interest. And a lot of us hear that term and we wonder, well, what the heck is carried interest? And in short, it's a lowered tax on income earned by investment managers who are, instead of being taxed at ordinary income tax rates, get a capital gains rate to be taxed on that on large amounts of money. So that's called carried interest, and that's also in the works. That's been in the works for many years. Maybe that'll go through this year. So one of the things I always like to talk about is what is triggering audits in the IRS. This year, audits are being focused on the wealthiest taxpayers. So taxpayers that are making over 10 million adjusted gross income and more. You can, I can think you can agree that those are the wealthiest taxpayers among us. Audit rates are now up to 16.5% of people filing returns of that nature. Audits under 400,000 in revenues on small businesses have gone down. So that's generally a good thing. A big target is coming up on trust fund recovery obligations. And those are taxes that are imposed on those of us who have a small business. If we have a small practice with employees, perhaps, we are obligated to pay those payroll tax withholdings to the IRS every month, every other week, every quarter, whatever the mandate is. And if we don't, we are personally liable over and above what our business is liable for if the business is not going to pay those taxes. So that's called trust fund recovery penalties. And it is 100% penalty on the individual who is the fiduciary in the business who does not pay those payroll taxes. So audits are going to be hot and heavy on trust fund recovery penalties this year. The IRS is going after small business non-filers. I'm seeing a lot more people coming through as referrals to our practice who are people who have not filed. And the IRS has now been catching up with people who are non-filers who own businesses. And that's because they're getting better at tracing and tracking income that's coming in from sources that didn't used to be on the IRS's radar. K-1s that are being filed by other companies, 1099s that are being filed by other companies. So that's all on the IRS's radar. And if they don't see an actual income tax return filed to report that income, that can be subject to audit. And so that's on their radar. Hobby losses, that's something that's always kind of on that mix. And the qualified business income deductions, which we're going to talk about in a bit as well. And if anybody out there has an aircraft, business use of an aircraft is high on the audit list this year as well. Sure. That's a great question. I am not aware of any data breaches. I guess any government agency is hackable. We've seen that in the news. There have been disclosures by IRS employees under various scenarios, but I haven't seen a general breach of privacy for IRS returns that are being e-filed. If you go to a tax preparer, all of our software is sanctioned by the IRS. It's reviewed, it's certified. Each tax preparer who files an e-file return has to have an enrolled number with the IRS. So in my mind, it's all pretty secure as far as e-filing a return.
Second question, go back to the Social Security topic. It would help Social Security get all what do you think the logic is to update?
Well, the logic, that's an open-ended question. I have no idea. On this slide, it does say that the Social Security wage base is going up to 176.1 for 2025, but that does not affect the Medicare wage base. That is unlimited. So
your mic just went out,
Oh.
Cindy.
I just renewed it. I'm sorry.
And to anyone, are you able to hear me? I don't repeat the question.
Yeah, we're not able to hear Drew ask the questions.
Okay.
Oh,
so,
I'm
so,
sorry.
so that's the first thing Cindy touched on was the first question in the chat, which was just how secure is and whether there have been any data breaches. The second question is more to what is the logic of stopping like that?
Yes, so that's always been capped. I don't know the logic behind it. I know that the Office of Budget Management has a lot to do with calculating what the income tax is going to be, what the base is going to be, what deductions are, how deductions are going to impact that flow of income. So it's all a balance within the government of why these caps are made and why they're increased every year. But as I was saying, the Medicare tax is unlimited. So that's always going to be there, no matter how much income you make. You can make $20 million in income, and that Medicare is going to be attached to that if those are wages. So any other questions at this point?
No more questions.
Okay, all right. So personal tax updates for 2025. Income tax rates are staying the same as they were in 2024. The amounts have gone up for each bracket, which means that we're actually paying a little bit lower tax in 2025 than we did in 2024. We're going to talk about credits, exemptions, and deductions. In your outline, it shows what all those personal tax incomes rates are, and we're certainly not going to read down the list as we go. But the different ways that you can file are as a single taxpayer, as a head of household, if you have a qualifying child or dependent that you have in your household, but you're a single person, or it could be a married filing separate person who qualifies for a head of household, married filing joint, and married filing separate. And you can compare to see what those rates are. One thing I did want to talk a little bit about is the qualified dividend and long-term capital gains tax rates. This is actually a graduated tax, and I didn't realize, a lot of people don't understand how this works. If you are filing a married filing joint return and you're making less than $94,000, chances are most of those capital gains that you have on your sale of stock, your qualified dividends are going to be taxed at a 0 rate. If you're over that amount, it's going to be taxed at a blended rate, starting at 0, and then the next one jumps to 15%. And the highest rate for capital gains is 20% if typically you're on a married filing joint return making over this $583,750 amount. That's the highest taxable rate for capital gains. Additional Medicare tax. This year it's staying the same as it did in 2024. If you are a single taxpayer and making wages of over $200,000, Your employer will likely impose this 0.9% additional Medicare tax on you, and you will see that on your W-2. If you're making less than 200,000 and you're married to a person who's making similar amount, but you're both going to be over 250,000 together, your employer is not aware that you might be subject to this tax, and then you're just going to have to pay that tax yourself on your own 1040 return. But either way, it is you as the employee and not the employer who's obligated to pay this tax. And the net investment income tax is still around at 3.8%. And this is on top of any investment that you have, not wages. So if you have wages and your adjusted gross income is going to be over $250,000 with wages and investment income, you're going to be subject to a 3.8% additional tax on that investment income, not on the wage portion of your earnings, but on the investment income. So for instance, if you have $300,000 of income and $250,000 of that is from wages, that $50,000 is going to be subject to the 3.8% net investment tax. Exemptions. Still no personal exemptions in 2024 and 2025. Personal exemptions may return in 2026 if Congress allows the sunset to happen with the Tax Cuts and Jobs Act. Standard deductions are going up a little bit this year to $15,000 for single filers, $30,000 for married filing joint filers. And there's an additional increase for those who are 65 and older or blind, an additional $1,550 per person on those additional deductions. Okay, itemized deductions. We have the standard deduction, which we just talked about. So $30,000 if we're married filing joint, $15,000 if we're a single taxpayer. But if we have deductions that are over that amount, then we have itemized deductions. And this is what's listed on our Schedule A if we're filing a 1040 return. The first section is personal medical cost. And if you have medical expenses that are over and above 7.5% of your adjusted gross income, you can take those medical expenses as a deduction. So medical expenses include pretty much everything that would go into a doctor, a dentist, an ophthalmologist, glasses, prescriptions, hospitalizations, and insurance premiums. Medicare is also included in that calculation. And long-term care. Long-term care is a deduction, but it is capped at certain amounts. So for instance, if somebody's 40 years old and has just purchased a long-term care policy, that person would be able to take a deduction for $470 this year. For those who are over 71 and you're making a premium payment, you can take a deduction for up to $58.80 this year for your long-term care deduction. So it's scaled according to the age of the person who's making the premium payment. Mortgage interest. That's calculated. There are some limits. If you have a large home and you're paying a large amount of mortgage, that could be capped. This is also something that's been on the table back and forth as to whether they're going to start disallowing mortgage interest altogether. So it's being bantered around. What also is interesting is that they're considering putting back car loan interest as an itemized deduction. And we haven't seen that in many years. So that might be coming back. We'll have to wait and see. The taxes, state, local, so that's your state income tax is a deduction, your property tax is a deduction. Property tax also affects the state taxes. So you get a credit for a property tax payment on your state income tax. So you always want to be sure to provide your tax preparer with income with your property tax information. And charitable deductions. Some of us have very large charitable deductions, not me, some charitable deductions, but not huge ones. I've seen clients with very large charitable deductions. And these deductions must have receipts. There has to be a letter from the charity or a receipt from the charity showing that you actually made the deduction the year that you're going to be taking it. And if you don't use up all your deductions in 1 year, you can carry those forward to the next year. Miscellaneous itemized deductions. I'm mentioning this here because if there is the sunset of the Tax Cuts and Jobs Act, in investment fees, tax preparation, and unreimbursed employee expenses may come back as deductions that we're able to take again. We used to be able to take these deductions. They've been kind of shelved. But if that law does not get changed before the end of the year, then in 2026, we may be able to take these as deductions once again. I wanted to make some mention of the unreimbursed employee expenses because this is something that came up a lot during COVID period when people moved home to work, but yet they had an office that their employer had for them. But by convenience of the employer or the employee or both, they were working from a home office. So those expenses are not deductible. That is not a home office. If you are an employee and you're working from home, you cannot deduct those expenses. So that might be a conversation to have with your employer. Maybe your employer can reimburse you for some of those expenses, but you cannot take those as a tax deduction. Updates on alimony, now called maintenance. I think under the tax code, it's still called alimony. If there is an agreement after December 31st, 2018, it is no longer deductible. If you are the payor, you can no longer deduct it. If you are a recipient, you no longer have to report it as taxable income. However, if your agreement was before December 31st, 2018, it is deductible if you are paying it to your ex-spouse, and it is reportable if you are receiving it from your ex-spouse, reportable as income. Child care credits. So child care credits are available to all parents, no matter what your income level. It's a 20% to 35% credit, depending on your income. So if you're making $10 million, you can deduct 20%. If you're making, I think, under 60,000, I believe, don't quote me on that one. It might be a higher, it will be a higher rate, but it could be that 35% rate. You can take childcare costs of up to $3,000 per child, as long as they're under age 13, up to 2 children for a total of $6,000. So if you have 3 children and you're spending $3,000 for each, it's still only $6,000 that you can claim. So in the example here, I say if you spend $20,000 a year on childcare, which is not unusual, for 3 children, you can still only claim that $6,000. The child tax credit is still here for 2024 and 2025. It may go away in 2026. We'll see if they extend it. It's a maximum credit of $2,000 per child, and it is income-based. For 400,000 or less as a joint filer, it goes away over that amount. There is also a $500 credit for other dependents. So if you have a child who is over age 17 but is disabled, or if you're caring for another dependent person, an aged parent or somebody in your home who is a dependent, they may also qualify for a $500 credit. Education credits. We're going to talk about 2 of them. There's a little bit of a difference between the 2. The American Opportunity Tax Credit is a 4-year credit for post-high school education. You can only take it for up to 4 years. It's 100% of the first $2,000 of expenses and 25% of the next $2,000 for a maximum of $2,500, but that is annually. So if your child is in school for 4 years, you can take $2,500 of a credit annually if his or her expenses are over these amounts. Up to 1,000 of that is a refundable credit, meaning if you don't owe any more taxes, but you're taking this credit, you can receive a refund of up to $1,000 for the credit. And it does phase out at income rates. For a joint filer, it would be at 180,000. You can no longer take the credit. and it starts phasing out at 160,000. The lifetime learning credit is available essentially forever, as long as you're taking the education in an enrolled and eligible institution. Higher education course, it can be toward a degree, it can be for a semester, it can be over a summer, as long as it's a qualified institution, and you can take up to 20% of the first 10,000. This is a non-refundable credit. So you can offset the income tax that you owe, but you can't get a credit that's refunded to you because of it. Earned income tax credits. This is generally for low income workers and families, and it reduces the taxes you're owed and the taxes you owe, and it increases your refund, and it is a fully refundable credit. It's for earned income earners under $59,899 and investment income below $11,600. So just because you have earned income of $25,000 but investment income of $100,000 doesn't mean that you can take the credit. You have to have a valid Social Security number, be a U.S. citizen or resident alien, and you cannot have foreign earned income. The IRS does also have people who file earned income tax credits on their audit list every year, year after year. And it's unfortunate because a lot of people depend on these refunds when they file their returns early in January. And the IRS often holds those refunds until they can do some research on them, and those processing times for earned income tax credit returns are often a lot longer than a typical return not claiming the credit. Energy credits are still around, and they've been extended for an additional 10 years. So a credit is available for a car of $7,500 and $4,000 for a used vehicle. These are for electric vehicles. It has to be in the year the car is delivered. So if you order and pay for a car in 2024, but the car is not delivered until 2025, the credit cannot be taken until 2025. The solar tax credit, this is a fantastic credit if you're going to install a solar system, because it's 30% of the overall cost of the system, which usually is quite large, a quite large cost. So as an example, I show here a $20,000 cost with a 30% credit. It's a $6,000 tax credit, which is amazing. And out-of-pocket cost then to you is really only $14,000 because you're getting that subsidy of the $6,000 on your tax credit. There are other tax credits available for property, for energy. Energy related to home improvements, your windows, your insulation, appliances, furnace. There has to be a certification of these items from the manufacturer, and that should be reported on your tax return. Up to 30% for the cost of installing energy efficient upgrades. You can have up to 2 doors, exterior doors, $250 credit. Exterior windows, skylights, central air, water heaters, furnaces, up to $600. And then heat pumps, biomass heaters, I'm not sure what that is, and boilers, $2,000. And there's no lifetime dollar limit. So if you buy more doors or more windows in a future year, you can take additional credits. Okay, any questions before we move on to business deductions, which are near and dear to most of our hearts? Questions? No questions. Okay. Business deductions. So what should be reported on a business income tax return? And my advice to you is everything should be reported. When we have an audit, oftentimes the IRS will ask for bank statements. And so the first thing the IRS does in an audit is to compare what you've reported on your bank to your bank as deposits for the year. And if those don't match what you've reported on your income tax return as gross income for the year, there's going to be a big red flag, and the IRS is going to want to know why that difference is there. So first report all the income. You can always deduct it later. You know, if it's a reimbursement from somebody and it's reported on a 1099, and you think, well, that's not really income because I paid it out of pocket and then they paid me back. No, report it, and then you can take as a deduction later on the tax form. So what we're going to be talking about for these business income and deduction items are germane to whether you file a Schedule C as a sole proprietor or a sole member LLC, whether you file a 1065 partnership return, whether you file an 1120S return as an S Corp, or whether you file an 1120. If there's a difference in some of these, I will make mention of that, but they should be applicable to whatever income tax return you're going to file. First of all, car expenses. Car expenses can be taken in two different ways. You can take actual expenses for your car, or you can take a per mile deduction for that vehicle. Once you put that vehicle into service and you start taking that option of how you're going to take that deduction, you have to continue with it for that life of the vehicle. So you can't choose to take a per mile deduction this year and take an actual expense deduction next year. You have to choose one and stick with that. So actual expenses, what goes under that kind of a deduction for a car? Well, first of all, if you're taking an actual expense deduction for your car, you want to make sure that you're using it for over 50% business use. Otherwise, you should be taking a per mile deduction. So if you do have a car that you purchased for your business and you use it for over 50% use, you can take your parking and tolls, your gas, your oil, your repairs, your car washes, your licenses, your insurance, and you can depreciate that vehicle. If you're leasing it, you can take your lease cost. Those are your actual expenses on your car. If you're taking a mileage deduction, you can take a per mile deduction in 2025 of 70 cents a mile. And you can also take your parking expenses and your tolls. Make sure that you keep receipts of all of the deduction items that you're taking for your car. So if you're taking a parking deduction because you drove downtown to court, keep that receipt and write on the back of it, you know, court, such and such date. And make sure you keep that with your log. The log of car expenses should be a contemporaneous log of your miles. Whether or not you're doing a per mile deduction or an actual expense deduction, you get into an audit of your business and the IRS is going to be targeting that car expense deduction right off the bat. And the first question that they're going to have is, do you have a log of your miles? And if you don't, they are going to disallow that deduction, and that $5,000 deduction you had goes away, and you can't prove it and you can't get it back. So you have to keep a log of your miles. There are apps that you can use to keep in your car. Every time you get into it for business use, you keep track of those miles. You can write it down on a sticky and, you know, upload it to your spreadsheet every night. Write it on a calendar, you know, whatever you want to do, as long as it's a contemporaneous log of your use of that car. You have to have that for the proof of your use of that car. Okay, depreciation. This applies to cars, and it applies to any other item that you're using in your trade or business. A lot of us have heard about Section 179, bonus depreciation, acres, makers, all of these forms of depreciation. And we've enjoyed for the last few years bonus depreciation, which is probably going to go away after 2026. It might be extended, but this allows us to take a greater upfront deduction on a new asset that we've purchased. First of all, let me talk about Section 179 expenses. In the outline, if you want to take a look on page 12, it describes a lot of the depreciation that you can use for your car and what qualifications you need for each car. In 2024, a Section 179 expense deduction is available for passenger vehicles of up to $12,400. Now that would be for a car that's used 100% in your trade or business. If you're using that in part, let's say 60% of that car was used in your business, you would multiply that $12,400 by 60%, and you'd be able to take that as a deduction this year. Then next is bonus depreciation. Or let me go back for a minute. If you have an SUV or a heavier vehicle, you qualify for a greater 179 expense deduction. In 2024, that amount is $30,500. So it behooves us to go and take a look and see what car we bought and how much it weighs. A lot of car manufacturers understand that there's this nuance in the tax code, and they build cars that might weigh 6,001 pounds. So take a look at your passenger vehicle and see how much it weighs and see what classification it can fit into when you're trying to take these depreciation deductions for it. It might serve you well. So bonus depreciation in 2024 is 60%. In 2025, it drops to 40%. And I think in 2026, it's dropping to 20%, and then it's going away. Bonus depreciation allows you to accelerate the depreciation. You can use it together with the Section 179 expense deduction. And then whatever is left after your 179 expense deduction and your bonus depreciation deduction, the rest gets depreciated over the remaining 5-year period. A car has a 5-year life, according to the IRS. So you can make it last for 20 years, but it still has a 5-year life for depreciation purposes. If we're looking at other items for depreciation, office furniture falls into a 7-year category. Office furniture would still be qualified for Section 179 or bonus depreciation, but it has a 7-year life. Residential real property has a 27.5-year life. And commercial property has a 39-year life. Real property does not qualify for 179 deductions or bonus depreciation. So just to make a note of that. However, sometimes when you're purchasing a property and you're putting in new appliances or new carpeting or upgrading the property, some of those items that you're putting into the property can be depreciated over much less time than those 27.5 or those 37-year periods, and they could qualify for the 179 and bonus depreciation deductions. So without trying to confuse you on all of these things, are there any questions on depreciation? Okay, maybe you're totally confused, maybe you've turned me off, but these are all things that affect us all. And at least it throws it out there so that you can have the questions ready for your tax preparer when you go to ask him or her, how should I report this new car that I just bought this year? Are there credits available for being able to buy this electric vehicle, et cetera, et cetera. So just to put these things out there and have them on your radar so you know the questions to ask. Other business income, business deductions rather. Travel and meals, this year it's at 50% for most meals. In order to qualify for the meal deduction, you have to be accompanied by somebody, and you have to be talking business during the meal to be able to take that deduction. So if you take somebody out to lunch, a colleague or a client, and you pay for the bill, 50% of that is deductible for you. Always, always keep your receipts or make some kind of a note on who you were with and what you discussed for that business use, for that business meal. And you have to discuss business during the meal. There are some exceptions for 100% deduction for holiday parties and all employee meetings. So if you have everybody stay after work and you order pizza and have a meeting, that could be 100% deductible expense. Office and home. This is something that a lot of us have. A lot of us moved home during COVID and stayed there and decided, why should we have an office outside of the home? It makes a lot of sense for some people. So you cannot have an office and home and deduct it if you are if you are an employee, as I said. You must be self-employed. You must not have an office elsewhere. So if you have an office that's set up for you downtown and you decide to stay out in the suburbs and stay at your home office most of the time, that office downtown disqualifies you from being able to take a home office deduction. So when you have an office and home, let's say you use a spare bedroom or a side office room, or maybe you construct an addition to your home for it, you have to have exclusive and regular use of that area in your house. It has to be used principally for your business. So it can't be a multi-purpose room where your kids come in and they share your computer and they have sleepovers and things like that. You have to keep your business records there, your file cabinet, your phone. Used to be when you had a landline, the business phone had to ring there. Now everybody has the mobile phones. Not so many of us have landlines anymore. So that's not a test anymore. But if you're going to be moving and you have an office and home that you've been claiming, take a picture of it. And then after you move, if there's an audit, you have that picture that shows where your home office was, so that you'll be able to prove, yes, it was an exclusive area. Here was my desk and my chair and my computer set up and my files and things like that. The good thing about an office and home is that a lot of the expenses that we already have in having a home or an apartment or a condo, we can now take as a tax deduction. So for instance, let's say that you use your office, 10% of your house is your office, rather. That means that you can take 10% of your mortgage interest, you can take 10% of your property taxes. And you're saying, well, we already take that as a deduction. But now you get into things like utilities. You can take 10% of your utilities, 10% of your homeowner's insurance, 10% of your assessments, anything else that goes into that house, repairs, general repairs to the house, or exclusive repairs to your office. If they're exclusive to your office, they could be 100% deductible, might be depreciated. But if they're for the whole house, they would again qualify for 10% of a deduction for your home office. Okay. Education. This is for you or for your employees. So as an employer, you can contribute up to $2,550 to an employee for their furtherance of education. So let's say that you have somebody who's working as a secretary and you say, well, I'd like to have that person get some paralegal training. You can pay up to $5,250 for that person's tuition. It's deductible to you as the employer, and it's not taxable to the employee as an employee benefit. So that's a great way, to get somebody additional education and be a tax deductible to you, be profitable for your business to have them have that additional education. And it's a perk to them for being able to take it without having to pay a tax on it. For yourself, seminars, CLE, coursework you take are deductible expenses. But even going beyond that, let's say that you're an attorney and you want to go on and get your LLM. Okay. The IRS says that if you take coursework that does not qualify you for a different profession, it's deductible to you as the taxpayer. So if you go on and you get an LLM or you get an MBA or something that's going to help you in your law practice, but is not going to qualify you for some other career, it's a deductible expense. So think about what you would be paying in tuition and being able to take that as a tax deduction. It's a really great perk. It's allowable, and so you can take advantage of that, whether it's a degree program or not. So that's fantastic.
Cindy, we had a question.
Yes.
Going back to the section 179 and asked cost segregation.
Sorry, Drew, we still can't hear you. You're going in and out.
Oh, you want to sit in front of the? This is Drew.
Hi, everyone. The question here is the cost segregation for 179 as to real estate? Meaning if you take 10% home office selling, you do not get the homeowner's gain exemption, correct?
I think, I understand the question. It's a little bit, misworded. But I think I understand what you're asking. So the question is, when you have an office and home, I think the question is, when you sell your home, do you have to recapture any depreciation that you might have taken on your office and home when you were using it, for that purpose? And the answer is yes, you do have to recapture depreciation on that section of your home that you used. But on a 39-year stretch of depreciation, the depreciation isn't all that much for an office and home. So you do enjoy getting that deduction while you're using it. You do have to report it as recapture of depreciation when you sell the home.
And then we also had another question here about education. It says, isn't job-related education for employees 100% deductible?
It's up to 5250 that's allowed for employee training. If that's a more specific question, I can look into that more, but that's generally the way it's handled, that it's up to that 5250 for employee training. If it's an in-house training or you're having a general seminar, that might not fall under that category, but this is specific to an employee being trained either in a college or outside of work training, usually for a degree of some kind.
Kind of piggybacking off of the education, it says, how far back do education deductions go if you took courses several years ago? Can you then still take a tax deduction this year?
If you had coursework that you took a number of years ago, and it's still within the 3-year period, look back period, you might want to amend your return to take those deductions. And again, you can go back 3 years. Once it goes beyond that period, those years are closed by the IRS, and you cannot go back and try to get a refund from any of those closed years. So I believe this year it would be 2022 would be the oldest year you could go back to be able to claim an additional deduction for those expenses.
Can the 5250 employee deduction be an independent contractor?
I would say no, they have to be an employee. Otherwise, you could pay for that person's education, but it would be income to them for it.
Another question, this is about the home office. It asks, are there safe harbor rules for home office deductions?
Safe harbor rules, again, exclusive use. You cannot have a mixed use of that area. You have to have your business records kept there. Those are the safe harbors. Those are the things that the IRS would look at to see and make sure that you don't have another office somewhere else that's also being used for that same business. Those are the safe harbors as far as I can see. I did want to make one more thing. Is there another question?
One more just general question.
And I want to go back to home office for a minute.
Yeah, the general question is just what does, I assume the IRS, what is considered a receipt in an age of paperless transactions?
Oh, okay. Well, yeah, you're right. If you go in and use the iParkit app or something like that, I would download your credit card statement that shows that transaction and write next to it what that thing was that you were attending, whether it was court or to see a client or something like that. There has to be a record somewhere. So write it down somewhere when you do it. Otherwise, you wait till the end of the year. You're never going to remember where you were, what you were doing there that day, et cetera, et cetera. Make sure it's contemporaneous somehow. Okay.
And then one more here that you might be able to tie in. I know you said you wanted to go back to the home office anyway. Yep. The question is there a standard amount that you can take for home office?
That's a great question. It really depends on how large your home is. I've had clients that have taken up to 27.5%, who have lived in a studio size condo. They used a large part of that condo for their home office, but it was a legitimate deduction. And even though that person was continuing to live in that condo, I had her take pictures of it because I thought because the amount was so large that it could be, a red flag. She was never bothered by any audit on that amount, but we had the evidence just in case. Some of my clients take a 3% deduction. They have an office in a normal size room, but they have a huge house. So it depends on really the size of your home or your condo or your apartment. And this does also equate to rent. If you're renting, it would also go over to the percentage of your rent on an apartment. The other thing I wanted to mention on office and home is relating back to the mileage. Business mileage means if you have an office and home, the first mile every day when you leave that home on business and round trip back to your home at night. So for a mileage deduction, it's an amazing mileage deduction because none of those miles are going to be commuting miles. However, if you have an office, the miles from your house or your condo or your apartment to that office are considered commuting miles, and those are not deductible miles. Those are never deductible miles for you. So for those people, the business deductible miles start from the time you leave your office that you've commuted to, and you go to see that client, or you drive to court, or you drive to the bank, or you drive to wherever other area you're going to for business. And those are your business miles. And then you come back to your office and then you drive home. And again, the office to home miles are commuting miles once again. So make sure that you make a distinction on commuting miles versus business miles. But for office and home, it's great. Okay. Independent contractor versus employee are other areas that we want to talk about a little bit. Make sure that if you have somebody working in your office and they're receiving a 1099, that they are not actually an employee. Those audits are ripe for not only IRS, but Illinois Department of Employment Security, Illinois Department of Revenue. Everybody wants to get their hands on deciding who was an employee versus who was an independent contractor. And there are a lot of audits at a lot of levels on people who are being used that way as employees or independent contractors. Insurance, all non-health insurance that's used in your practice, whether it be liability, malpractice, business casualty, E&O insurance, all deductible insurances for your business. Health insurance, for those of us who are self-employed, meaning a sole proprietor, a partner, or a shareholder in an S corporation, health insurance is deductible against our income, but it does not reduce the amount of Social Security tax we're liable for. So we could have $100,000 of income, $10,000 of health insurance deductions. We're only going to be paying income tax on $90,000, but we're going to be paying Social Security tax on $100,000. Legal and professional services, businesses can deduct up to $5,000 in startup costs this year. Any amounts over that amount need to be amortized. And ongoing use of attorneys might be deductible or could be capitalized depending on the use that we're using our other colleagues for in our trade or business. Rents are always deductible. Repairs are generally deductible if they're small repairs. If they're larger repairs that go into extending the life of an asset, those would be what they call capital repairs, and those would be subject to depreciation. Supplies that we use in our business, paper, toner, paper clips, pens, all deductible as supplies. If any of your clients are in a trade or business that uses inventories, that's different from supplies, and that's treated differently for tax purposes. Taxes and licenses, if we're having employees, our payment of Social Security employer portion is a deduction for our income taxes. Local taxes, licenses, permits are always deductible. State income tax is not a business return. Travel and meals, we talked about. We went over all of that. So I'm just going up to the qualified business income deduction. A lot of us have been able to use this over the last few years. This is part of the Tax Cuts and Jobs Act, so it is going away at the end of this year. There is talk about extending it, which would be great. It's up to a 20% deduction on business income for small businesses. It was supposed to help boost small businesses be able to hire additional people, spend more money, lower taxes. This does not, again, lower self-employment tax. So again, if you're making $100,000, you get a 20% deduction, $20,000. You're paying income tax on $80,000, but you're still paying self-employment tax on $100,000. And it's available to sole proprietors, LLC, sole members or partners, and S Corp shareholders. As I said in the beginning, this is an area that the IRS is targeting because there's a lot of abuse. You can imagine if it's a large deduction like this, a lot of people are taking improper deductions. But if you do this correctly, it's a fantastic boost to your bottom line with the taxes you have to pay as a small business. 1099s, NECs, 1099s, MISCs. As attorneys, we're getting many of these documents coming in from our clients who have paid us during the year. If they pay us over $600, they need to file one of these documents for us. And the IRS says for an attorney, you can either file the NEC or the MISC. And as business owners, as attorney business owners, if we pay a vendor more than $600, we need to give them an NEC or an MISC if they are not a corporation. So we don't have to pay a corporation. We don't have to file these for corporations, but we do have to pay individuals, LLCs, partnerships, and non-corporate entities for amounts that we paid over $600 in the year. And then also retirement plan and employee benefit deductions. And we're going to talk about retirement plans right now. Any questions as we go on the business before we get started?
There was one final clarification on the sale of home. And so the clarification is there's a depreciation recapture for home office on the sale of home, but the home office does not affect the gain exclusion when selling the home. Is that right?
The gain exclusion. Oh, you mean on the person? Yes. The gain exclusion. No, it would not affect your exemption from paying capital gains on the home itself, only for that recaptured amount. Does that answer the question? Well, we don't know.
I believe that answers the question,
Yes.
but if Stephen, if it does not, please let us know.
You still qualify for the homeowner's exemption. Yes, you do.
He said,
Yes.
thank you, yes.
Okay, great. Okay. So moving on for retirement plans. Updates for 2024 to 2025, 401k contributions. The employee in 2024 is allowed to contribute up to $23,000. That bumped up a little bit in 2025 to $23,500. There is a catch-up amount for those employees over 50 of $7,500 for both years. And there's an additional catch-up. This is under the Secure Act, and that's kind of curious, that for those employees between ages 60 and 63, in 2025 only, they have an additional catch-up of $3,750. I have no idea why that came about, but it's only available for 1 year. If we are employers and employees of our practice, we can contribute up to $69,000 in 2024 and up to $70,000 in 2025 for ourselves plus the catch-up if we're over age 50. And plus the catch-up if we're between ages 60 and 63 in 2025. So that's a large dollar amount that we can contribute toward a retirement plan and take as a business deduction. So it's really benefiting us in a lot of different ways, tax purpose. There are also Roth 401k options available. And a lot of people don't realize that this is not limited to income. So when you think about a Roth IRA, a lot of people are unable to contribute to a Roth because their income level is too high. But if it's a 401k Roth, there is no income limitation. So you can be making $1 million and still be able to contribute to a Roth 401k. Okay, in 2024 and 2025, all IRA contributions are $7,000. And there's a $1,000 catch up if you're over age 50 by the end of the year. You can contribute part to an IRA, traditional IRA, and part to a Roth. So you can mix it up, but total amount can only be $7,000. So if you put that $6,000 into a Roth, you can only put an additional $1,000 into a traditional IRA. The Roth phase outs in 2024 and 25. For a married filing joint, they phase out completely at at the income level of $228,000 in 2024 and $240,000 in 2025. Where it gets kind of complicated with retirement plan contributions is that if your employer has a plan available, you are limited to the amounts you can put into your own IRA outside of your employer's plan. And this is where you need to have a knowledgeable financial advisor, or you need to know where to look in the IRS instructions of what you can contribute outside of your employer's plan. And how do you know if you're enrolled in your employer's plan? When you get your W-2, there's a check the box on the W-2 that says retirement plan. And even if you don't contribute to that plan, you're still beholden to being limited to the IRA outside of your employer. So make sure that you check to see what those limitations are and whether you're actually enrolled in a employer plan. There are some sneaky ways to get some money into Roth IRAs, even if you're over these income limitations. And again, you need to work with somebody who knows what they're doing. So a financial advisor who's done this before, an attorney or a tax preparer who's done this before. There's something called a backdoor Roth IRA, where if you're over the IRA contribution amounts, you make a non-deductible contribution to a traditional IRA, and then you can convert it into a Roth. So that's kind of what they're calling the back door. You do it kind of surreptitiously through the back door, but it is legal, so you can do it. And then there's also something on 401k contributors called a mega Roth conversion. And I say, please don't try this without a knowledgeable advisor, because it allows you to contribute more and to overfund your 401k plan and then convert it into a Roth 401k plan without any tax consequence. But be sure that you roll it over immediately, because if that money starts generating income inside that 401k, you're going to have a lot of trouble unraveling those taxable amounts. Okay, qualified charitable distributions. This is an amazing thing for people who are receiving RMDs. It's available for people who are over 70 and a half. Right now, the RMDs are required at age 73. That went up under the Secure Act. But if you're over 70 and a half, you can take an RMD and you can have it directed to a charity through your financial advisor. So you cannot take the money out yourself first and then donate it to the charity. It has to be a direct transfer from the IRA or the 401k to the charity. And by doing that, you don't have to report the income from your RMD. You don't get the charitable deduction, but not reporting income is oftentimes more beneficial from a tax perspective than getting the charitable deduction. It reduces your modified adjusted gross income, which sometimes triggers other tax avenues. It definitely triggers the Medicare premium calculation. So by reducing your overall income and having it go directly to charity, you're benefiting yourself in a lot of ways. Now, under the Secure Act, in 2025, there's going to be automatic enrollment in employer plans for all employees unless they opt out. So before, the employees would have to opt in. Now they have to opt out. So it's a 3% automatic contribution that the employee must make. And this is because for young employees like Drew sitting across the table from me, there may or may not be Social Security when he's ready to retire. So they want to encourage and essentially force people to save for their retirement early on as they go. There's an ability to convert 529 unused funds in a 529 to a Roth IRA. And this is when you have a 529 set up for your child or your grandchild, and now they've finished with their education and there's still money left in that 529. It used to be we can only take money out from a 529 if we pay a penalty for taking it out if we're not using it for education purposes. Now they're saying, okay, there's money left there, you can convert it to a Roth IRA, which I think is a great benefit. We talked about the increase in the catch-up contributions of $11,250 for those in this age bracket. Matching student loan payments. If an employer has a matching plan, so an employee contributes 3% to their 401k, we can contribute an additional 3% matching that contribution. Instead of having that employee make a contribution to their 401k, if they have a lot of student loan debt and they're making payments to that student loan debt, the employer can match the amounts that the employee pays to the student loans by putting that matched amount into their 401k. And that's a nice perk. The Secure Act is also allowing $1,000 emergency withdrawals without penalty. So that's a perk. Okay. Distributions now for RMDs started at age 73. That started in 2023, and it's eking up to age 75 by 2033. So that means if you want to, you can start picking RMDs. You don't have to until you reach those ages. It reduces the penalty on RMD failure from 50% to 25%. I've had this happen a couple times with clients where the financial institution did not send out an RMD by the end of the year for whatever reason. Maybe they were waiting for the client to request it. Maybe they didn't have it on their calendar to do it, but the RMD didn't arrive till January. It was subject to a 50% penalty of the RMD amount. It's a huge penalty. And in one case, we got the financial institution to pay the penalty. In the other case, we didn't, and we had to get it reduced through the IRS. But that's been reduced from 50% to 25%. So that's a substantial reduction in the penalty, and it does benefit a lot of people who fall into that mistake category. And the IRS is setting up a searchable database for participant or beneficiary to locate a benefit that might be abandoned. This might come about if somebody has died and nobody knew that there was such a plan in place. And a lot of times people skip around from employer to employer and they leave their plans behind. and they don't realize that, you know, they have 6 plans that are somewhere. At least now there'll be a database because the IRS does track all of this information. Okay, I'm gonna try to play a little catch up here because I'm falling behind. But we took a lot of questions in the middle, so maybe we won't have so many questions at the end. Federal and gift tax, in 2025, the exemption has gone up to $13,990 per person. In 2026, if the sunset happens at the end of this year, it's going to drop down to maybe 6.5 million. So it's going to drop substantially. This may be an area that's going to be extended by Congress. I have not heard anything about it yet, but I'm certain that that's going to be extended in some way. The annual gift tax exclusion is up to $19,000 per person this year. This means that you can give anybody in the world $19,000 today and not have to file a gift tax return. If you give them $20,000, then yes, you have to file a gift tax return to report that gift to that person. The Illinois estate tax exclusion remains at $4 million per person. So even though the estate tax for the federal returns are kind of in the stratosphere, if you're having an estate worth over $4 million, there has to be an estate tax return filed. And unfortunately, there also has to be a federal estate tax return prepared because Illinois uses it as an attachment, as an exhibit. So you won't save any money for the tax preparer on an Illinois estate tax return just because you're under that $13 million amount. Okay, I just want to touch base quickly on FSAs and HSAs. An FSA is a flexible spending account. It's set up by your employer and is generally for medical expenses. And you can contribute up to $3,300 into that account pre-tax dollars. So it reduces the amount of income that you're having to pay tax on, and it saves that money for your use during the year. Be cautious though, only to fund it with the amount you think you're going to use during the year, because the rollover on an FSA is only $640. So if you fund it with $3,300 and you only use $300, you're going to lose that money that doesn't roll over. You only get a $640 rollover. An HSA, on the other hand, health savings account, for a family, you can contribute up to $8,500, $8,550 in 2025. There's a catch up for age 55 and older. You can contribute up to it up to April 15th of your, or when you file your tax return for this year. And the good thing about HSAs, and I just actually was at a seminar yesterday about HSAs, is it acts kind of like an IRA. It rolls over from year to year to year. You don't have to use it up in the year that you're contributing to it. So this can be something where you're investing the money that's in here. It can grow quite substantially over the number of years you're contributing. And it's contributed with pre-tax dollars. So it's reducing the amount of income tax you're paying on your income by contributing to it. So it's a fantastic plan. There's also an FSA for dependent care contributions, $5,000 per household. A lot of people with children will have this plan set up with their employer because it uses, again, pre-tax money. And it's a better benefit than there would be on the child dependent tax credit that we talked about earlier, better tax benefit. Illinois remains at the 4.9% tax rate. Personal exemptions are $2,850 in 2025. You get an additional exemption amount if you're over 65, and additional if you're blind. There are certain deductions for dividends. Abbott, AbbVie, Caterpillar, and Walgreens. If you have any dividends from those companies, that's subject to a subtraction on your Illinois return, and you don't have to pay tax on those dividends in Illinois. 529s, there are great deductions if you're contributing to a Bright Start or a Bright Directions plan for your child or your grandchild. $10,000 for single, $20,000 for married. Fantastic deduction on your state income tax return. But be careful if you are the owner of the 529 plan and there's a withdrawal for elementary or secondary school, you can withdraw up to $10,000 now for K through 12 distributions. But in Illinois, it's one of the few states that actually taxes that. So be aware of that. If you're up in Wisconsin, I don't think they do tax on that distribution, but Illinois does. One more thing I wanted to make mention of. A lot of people have heard of FBARs, and it stands for Report of Foreign Bank and Financial Accounts. And it's run by an agency of the government called the Financial Crimes Enforcement Network. Crimes Enforcement Network. It should make you shudder. It makes me shudder. This is the agency that tracks foreign investments. And years ago, when I was working within the IRS, it became an issue where the Swiss banks weren't reporting the accounts that Americans held overseas, and the IRS wanted to get a better handle on what was out there. What kind of holdings did US citizens have overseas? And so since the early 2010 timeframe, the IRS has been tracking this steadily. And when it first started becoming enforced, there were a lot of criminal charges attached to people who are holding foreign bank accounts. Now it's become a little bit softer, where it's a reportable, it's a high penalty if you don't report it. But keep an eye on things. If you have an account overseas, if you have a joint account overseas, if you have an investment overseas, and you have an account that has over $10,000 on any day during a calendar year, and these are cumulative. So if you have an account that has 2,000, you have an account that has 5,000, you have another account that has 5,000, that puts you over that $10,000, and you have to report those accounts, whether or not they're generating income. This doesn't apply if you have a house or you have a condo in another country, only if it's an income financial account. And this document, it's called the Form 114. It's actually filed with FinCEN, but you can file it through your tax preparer. We file quite a few Form 114s, and we file them with the person's 1040 return, but they're routed to FinCEN instead of to the IRS. And it's a reportable requirement. You don't have to pay tax on this reporting, but it has to be reported. So if you do have overseas accounts, if you have relatives who you think might have put you on an account, please check it out, because it is subject to large penalties if it's not reported. Okay, we are down to questions, and we have about 8 minutes for questions. And Drew, are there any questions? No questions.
Oh, here's one.
Oh, we have questions.
Does FBAR include foreign pensions?
Yes. Yes, FBARs do include foreign pensions. They are reportable. That's something you would want to get the information on and report. Yes. I've had some clients who have had pensions, bank accounts. I had one client who had an account they forgot about, and all of a sudden they got a letter from the IRS saying, you know, you have this account. It was maybe $12,000. The penalties were greater than the amount that was in the account. So not only did he lose the money that was sitting there, he had to pay penalties well in excess of the amount that he had. Other people who have fallen into trouble with this are people who don't realize that a relative have put them on a joint account. Here domestically, we work with a lot of estates where people who are getting up in years add their child onto their bank account simply for a convenience. They want the child to help them pay the bills, monitor their accounts, etc. That can happen overseas as well. So if you have any relatives that might be inclined to do that, I had one client who had a grandmother that set up an account for them in Germany, and they had no idea, but IRS found it, and then all of a sudden there's an FBAR problem. So it's one of those areas that you want to be sure that you keep track of.
Next question is, can you talk a little bit about donor advised funds?
Donor advised funds. Okay, that was not on our list, but I can talk a little bit about that. A donor advised fund is something akin to a private foundation where you make a usually large contribution to a fund that's set up with usually a financial institution that takes over the control of making donations on your behalf to the charities that you have essentially chosen in advance, and you have some direction over. But we've worked with clients who have set up private foundations and set up donor advised funds. And there's actually a larger charitable carry forward or large charitable first year deduction for a donor advised fund contribution than there is for a private foundation. But you have less control over how and when those funds are going to be distributed to the charities through a donor advised fund. But some of the perks are you don't have to file your own tax returns. You don't have to have somebody, managing the requests for donations that are coming in as you would with a private foundation. So it's a lot less hassle and expense to have your money in a donor advised fund rather than in a private foundation. So if you have a specific question, I can try to answer that. If not, I hope I covered your concern. Okay. Anything else? We have a few minutes left. Aviva, do you have any questions?
No, I was just looking to see whether anyone had posted anything, just me.
Okay.
See any
We
questions?
covered a lot of material. I believe on the handout, my email address is there. If you do have some follow-up questions, I'm happy to answer some. If you want to call us with a tax issue, we're always happy to discuss those with you. So if there are no further questions.
Okay, well, thank you very much. This was an excellent presentation as always, and we appreciate so much you coming here.
Thank you for having us. Take care and good luck.